Tax treatment of incorporated partnerships in the UAE. Overview of incorporated partnerships and legal personality. In the United Arab Emirates, UAE, partnerships can be established in a variety of forms, and some of these partnerships are incorporated with a separate legal personality. The most common examples of incorporated partnerships are limited liability partnerships, LLPs, and limited partnership companies. These types of partnerships are different from unincorporated partnerships, as they are legally distinct entities from their partners. An incorporated partnership is one where the partnership itself is registered as a separate legal entity under UAE law, giving it a distinct legal personality from its individual partners. This means that the partnership can own property, enter into contracts, and incur liabilities in its own name, independent of the personal actions or assets of its partners. Tax treatment of incorporated partnerships in the UAE. Because an incorporated partnership is treated as a separate juridical person, or legal entity, under UAE law, its tax treatment aligns closely with that of other juridical persons such as limited liability companies, LLCs, and public joint stock companies, PJSCs. The partnership, as a juridical person, is required to adhere to the same corporate tax obligations that apply to these types of companies. 1. Corporate tax liability. As an incorporated partnership with a separate legal personality, the partnership itself will be liable for corporate tax on its taxable income. This means that the partnership must file its own tax return, calculate its tax liability, and pay the appropriate taxes, just like any other incorporated business entity in the UAE. The tax obligations for an incorporated partnership are based on the corporate tax rate established under UAE tax law, and the partnership must adhere to the same rules and regulations that govern the taxation of LLCs, PJSCs, and other juridical persons. 2. Distinction from unincorporated partnerships. It is important to distinguish incorporated partnerships from unincorporated partnerships in terms of tax treatment. In an unincorporated partnership, the partnership itself is not treated as a separate juridical person, meaning that the partners are directly responsible for reporting and paying taxes on their share of the partnership's income. The partnership's income is allocated to the partners and taxed at the individual level, depending on the partner's own tax status. However, an incorporated partnership is treated as an independent legal entity for tax purposes, meaning that the partnership itself, not the individual partners, is responsible for corporate tax. The partners are not directly taxed on the partnership's income unless they receive distributions or compensation from the partnership. 3. Tax filing and reporting requirements. Incorporated partnerships must comply with the UAE tax filing and reporting requirements that apply to juridical persons. This includes maintaining accurate financial records, preparing annual financial statements, and filing tax returns in accordance with the deadlines set by the Federal Tax Authority, FTA. The incorporated partnership must report its taxable income based on its accounting profit as determined under the relevant financial accounting standards, and apply any permissible deductions for expenses incurred in the course of its business operations. The FTA may conduct audits or reviews of the partnership's financial records to ensure compliance with tax laws and may impose penalties for non-compliance, so it is essential for incorporated partnerships to ensure they meet all requirements. 4. Treatment of profits and distributions. The profits generated by an incorporated partnership are subject to corporate tax at the entity level, similar to how profits generated by LLCs and PJSCs are taxed. The partnership will be taxed on its profits before any distributions are made to the partners. If the partnership decides to distribute profits to its partners, those distributions may be subject to additional taxation depending on the tax regime applicable to the partner. For example, individual partners may be subject to tax on any dividends or income received from the partnership, depending on their tax status and the nature of the distribution. In the case of a limited partnership company, the general partners, who may have unlimited liability, and limited partners, who have liability limited to their capital contributions, may be treated differently for purposes of tax and liability. However, the partnership as an entity will still be treated as a taxable juridical person. 5. Corporate tax compliance for incorporated partnerships. As a juridical person, the incorporated partnership must ensure compliance with the full range of corporate tax obligations, including the submission of annual tax returns, payment of taxes on profits, and compliance with any applicable deductions, exemptions, and tax credits. The partnership is required to maintain proper records and financial statements, which must be audited or verified in accordance with UAE tax laws and regulations. These documents will be used to calculate the partnership's taxable income and determine the amount of corporate tax that is due. 6. Impact of corporate tax reforms on incorporated partnerships. The introduction of the UAE corporate tax law has impacted all juridical persons, including incorporated partnerships. Since these partnerships are now treated as juridical persons, they must ensure they are in full compliance with the UAE corporate tax law, which governs the taxation of businesses operating in the UAE. The law sets out the key principles for determining taxable income, permissible deductions, tax rates, and the filing and reporting processes. Incorporating these elements into their operations and tax planning will be essential for maintaining compliance with the new tax regime. For more details, contact us.